You are listening to the Objects of Affection collection. Study 187. The only number the owner commissions, what an insurance schedule records. On the only number an owner commissions, and on what it is a price for every valuation this institution normally studies is produced by somebody who intends to be on the other side of the transaction. An auction estimate is made by a house that will take a commission. A dealer's price is what they will pay or charge. A market price requires two parties and describes the point at which one of them was willing to stop owning the thing. There is one exception, and it is systematic rather than incidental. An insurance valuation is a number the owner asks for, pays for, and keeps. Nobody is buying. Nothing changes hands. The figure exists solely to describe what this person would need in order to be made whole if the object were gone. It is the only valuation in the economy where the owner is the client rather than the counterparty, and this institution has never examined it. 3 different questions, all called value household policies, do not carry one idea of worth. They carry several, and the differences are the interesting part. Actual cash value pays replacement cost less depreciation. It treats an object as a decaying asset and assumes age reduces worth, which is true of a washing machine and false of almost everything this institution studies. Replacement cost pays what a new equivalent would cost. It assumes an equivalent exists, which is precisely the assumption a singular object defeats. Agreed value used for scheduled items differs in kind. Insurer and owner fix a figure in advance, usually on the strength of an appraisal, and that figure is what is paid. No depreciation, no argument at the moment of loss, no search for comparable. Ordinary contents cover falls under the first 2. Anything unusual must be scheduled, listed individually, appraised, and insured separately from the general limit. Consumer guidance from the insurance industry is consistent that jewelry, art, and collectibles exceed standard sub-limits and need this treatment. To insure a singular object properly, you must first remove it from the category of things a policy can price by rule, and give it a name and a number of its own. That is an accession record produced by an insurer, a schedule of specified items, each identified, described, valued, and dated, maintained by the owner because a contract requires it. It is the closest thing most private objects will ever have to a catalogue. One object, several correct values, and they are not in conflict. The number on a schedule comes from an appraiser, and appraisal is a formal discipline rather than an opinion. In the United States, practice is codified by the body that maintains the uniform standards, and the personal property societies, among them the American Society of Appraisers and the International Society of Appraisers, train and credential to those standards. The single most useful thing in that discipline, for this institution's purposes, is a requirement that sounds procedural and is not. Every appraisal must state its intended use, and the intended use determines which definition of value applies. The consequence is that one object has several different values at the same moment, all of them correct. Insurance replacement asks what it would cost to obtain a comparable item at retail, promptly, from a dealer. Fair market value asks what a willing buyer and a willing seller would agree with, neither under compulsion. Marketable cash value deducts the costs of selling. Liquidation value assumes a compressed timescale and a forced sale. For a singular object, those 4 figures can be very far apart, and the insurance figure is typically the highest of them, because it must fund a hurried retail purchase rather than a patient sale. An owner who reads their insurance schedule as what the thing is worth has read a number that answers a different question. This institution holds a standing rule against reconciling 2 values that disagree before establishing whether they answer the same question. It is instructive to find that rule already formalized, decades earlier, inside a profession this corpus had never examined. Appraisal did not have to discover that objects have several worths. It built the discovery into the definition of a valid report. The premium is a price for the object's absence. Here is the part with no analogue elsewhere in this institution's subject. A policy pays out only if the object is destroyed, lost, or stolen. The sum insured is therefore not a price for having the thing. It is an agreed price for not having it. The premium is what an owner pays annually for that agreement to stand. They are not buying the object which they already own. They are buying certainty about the size of the whole. Set against this institution's usual material, that is an inversion worth sitting with. A market price says what somebody would give to get the object. An insured value says what would have to be given to compensate for its going. The first measures desire, the second measures loss, and only the second is a number the owner chose. Where it fails, and the failure is the honest part, agreed value looks like a solution to singularity, and it is not quite. The money is fungible and the object was not. A policy that pays the agreed sum has discharged its obligation completely and has replaced nothing. For an object whose worth lay in having been kept, having been repaired, having stood in a particular room for 40 years, the settlement is exact compensation for the wrong quantity. Insurers know this and the vocabulary shows it. Cover is arranged for objects described as irreplaceable, and the contract's entire function is to name a replacement price for them. That contradiction is not sloppiness. It is the best available accommodation between a legal instrument that can only move money and an owner whose loss is not denominated in money. This institution's custodian's contract meets the same wall from the other side. It attaches obligations to an object because money is the wrong remedy. An insurance schedule attaches a number because money is the only remedy available. Both answer the same fact, that the object cannot be reconstituted, and each concedes what the other refuses. What the schedule proves about the owner, the most useful thing about a schedule, is that it is voluntary and costly. Nobody is obliged to schedule an object. Doing so means commissioning an appraisal, disclosing the item, accepting a higher premium, and often accepting conditions about storage or security. It produces no income and confers no right to sell. So a scheduled item is one about which its owner has said, at their own expense and unprompted, that its loss would matter enough to insure against. Like a repair, it is expenditure that yields nothing and proves an intention to keep. Unlike a repair, it is written down in a document that persists, carries a date, and is revised over time. An appraisal file maintained across decades is a record of what one person considered worth protecting and how that judgment moved. This institution has argued that provenance records only departures. An insurance schedule is one of the few private records that documents keeping, and it exists because a contract compelled it rather than because anyone valued it as history. It is also, for the same reason, the record most likely to be destroyed when the policy lapses. Material singularity asks that singularity be earned in the object. The schedule is evidence of exactly that, kept in a filing system designed to be superseded annually. The number is only ever tested at the one moment the object is gone. An agreed value is a hypothesis about a thing, and there is exactly one circumstance in which it is ever checked. The object has to be destroyed, lost, or stolen first. Until then the figure sits in a document, renewed annually, adjusted occasionally, and never falsified. Nobody takes the ring to the market to see whether the schedule was right. The number's correctness is unexamined for its entire useful life, and is examined only when the thing it describes no longer exists to compare it against. That produces a specific and well-known failure. Values move, schedules do not, and consumer guidance from the insurance industry's own information body recommends periodic reappraisal precisely because the gap between the recorded figure and the current one opens quietly. The owner discovers the size of that gap at the worst possible moment and cannot do anything about it afterwards. There is a documentary loss underneath the financial one, and it is the part this institution should care about. A schedule is maintained on a renewal cycle designed to supersede itself. Each year's version replaces the last, and the superseded ones are discarded as obsolete paperwork. The one private record that tracks how an owner's judgment of an object moved across decades is systematically destroyed by the routine that produces it. Compare the institution that does keep such records. When a museum lends, its loans process generates a valuation and a condition record for the object in transit, and both are retained. The object that leaves the building is valued and documented. The object that stays is neither. So even in the institutions built to preserve, valuation attaches to movement and risk rather than to keeping, which is the burden of preservation showing up as a filing convention. What is not established here, this study describes valuation bases and scheduling as they appear in consumer insurance guidance and general practice. Policy wordings vary by insurer, product and jurisdiction. In the United States, regulation differs by state, and it differs again by country elsewhere. Nothing here states what any particular policy covers, and no reader should treat it as advice about their own. No policy wording has been read in full for this study. No underwriter or appraiser has been interviewed, and no claims data examined. The claim that scheduling is voluntary and costly reflects general practice rather than a measured finding, and exceptions will exist. The argument that a schedule functions as an accession record is this institution's reading. It is not a claim that insurers or appraisal bodies regard it that way, and no such body has been asked. The account of appraisal practice describes how the standards and the personal property societies present it. No appraisal report was read for this study, no appraiser was interviewed, and no claim is made about how any individual practitioner works. Definitions of value differ between standards regimes and between jurisdictions. The statement that insurance replacement is typically the highest of the common value definitions reflects the logic of the definitions rather than a measured comparison across objects, and exceptions will exist. The description of a museum loan generating a valuation and condition record is taken from a published loans process at one institution and is not a claim about sector-wide practice. No indemnity or government scheme is described because the sources that would establish one blocked automated access when checked for this study. Coda somewhere there is a document listing a ring, a painting and a clock, each with a description, a date and a figure, renewed annually by a person who has no intention of selling any of them and has paid for years to be told what they would be owed if the objects ceased to exist. It is a catalogue of a private collection, compiled with care and updated diligently, produced entirely as a byproduct of arranging cover. Nobody involved thinks of it as a record of affection, and it is the only one most of those objects will ever have. This has been a study from the Objects of Affection collection, a critical art research institution operating under the framework of post-luxury conceptual functional art. Read the full research at objectsofaffectioncollection.com.